Did you know that the global stock market has a combined market capitalization of over $100 trillion? Or that in just a single day, billions of shares are traded, influencing the fortunes of individuals, businesses, and even nations? The stock market is an intricate web of buying and selling of shares which holds immense power over the economy and serves as a vital barometer of financial health and a catalyst for growth. But there's more to the stock market than just buying and selling off assets. Let's unravel the inner workings of stock markets and explore their profound impact on a country's economy. Understanding the stock market. Imagine a bustling marketplace where buyers and sellers come together to exchange goods and services. The stock market operates on a similar principle, but instead of physical commodities, it deals with financial instruments known as stocks or shares. The stocks represent ownership in a company and provide individuals with the opportunity to invest in businesses they believe in. There are also two types of stock markets: primary and secondary markets. In the primary market, companies issue new stocks through an initial public offering, IPO, or a rights issue. During an IPO, a company makes its shares available to the public for the first time, where investors can subscribe to these shares and become shareholders in the company. A rights issue, on the other hand, allows existing shareholders to purchase additional shares at a discounted price, and the funds raised through primary markets go directly to the issuing company. Now, the secondary market is where previously issued stocks are bought and sold among investors without the involvement of the issuing company. This is the most familiar concept of the stock market, where investors trade stocks on exchanges like the NYSE, NASDAQ, or London Stock Exchange. The secondary market also provides liquidity to investors, allowing them to buy or sell stocks at prevailing market prices. That's not all. To fully understand the concepts of the stock market, you must also know the several key players that contribute to its functioning. Investors. Investors are individuals, institutions, or funds that purchase stocks with the aim of generating returns on their investments. They can be categorized into various types, including retail investors, individuals, institutional investors, pension funds, mutual funds, etc., and speculators, traders looking for short-term gains. Brokers. The brokers act as intermediaries between buyers and sellers in the stock market. They execute buy or sell orders on behalf of investors and charge a fee or commission for their services. Brokers can be traditional brokerage firms or online platforms that facilitate stock trading. Exchanges. Stock exchanges provide a platform for trading stocks. These exchanges have specific rules and regulations governing the listing and trading of stocks. They ensure fair and transparent transactions, maintain order in the market, and provide market data to investors. Regulators. Regulatory bodies, such as the Securities and Exchange Commission, SEC, in the United States, or the Financial Conduct Authority, FCA, in the UK, oversee and regulate stock markets. Their role is to protect investors' interests, ensure compliance with securities laws, and maintain the integrity of the market. The role of stock markets in the economy. Stock markets are not just platforms for buying and selling stocks. They serve as dynamic engines that drive economic growth and development. So, by facilitating capital formation, providing investment opportunities, and acting as valuation mechanisms, stock markets contribute to the efficient allocation of resources and promote innovation and entrepreneurship. Now that we have a basic understanding of how stock markets operate, let's explore their profound significance in a country's economy and dive deeper into their role. 1. Capital formation. One of the primary roles of stock markets is to facilitate capital formation. When companies decide to go public by issuing shares through an initial public offering, IPO, they raise funds from investors. These funds, in turn, are utilized by companies to finance their operations, research and development initiatives, expansion plans, and other capital-intensive endeavors. By providing a platform for companies to access capital, stock markets contribute to economic growth and job creation. 2. Investment opportunities. Stock markets offer individuals and institutions a wide range of investment opportunities. Through the purchase of stocks, investors can become part owners of businesses they believe in and participate in their growth and success. Investing in stocks also allows individuals to allocate their savings to various companies and sectors, potentially earning returns on their investments through dividends and capital appreciation. Moreover, stock markets encourage long-term financial planning and provide a means for individuals to build wealth over time. 3. Valuation of companies. Stock markets play a crucial role in determining the value of companies. Through the buying and selling of stocks, investors express their opinions about the prospects and worth of a company. These opinions are reflected in the stock prices, which, in turn, indicate the market's perception of a company's value. 4. Liquidity and risk mitigation. Stock markets provide liquidity, which enables investors to buy or sell their stocks easily. This liquidity is vital for the efficient functioning of the economy because investors can swiftly convert their investments into cash and provide them with flexibility and liquidity when needed. Additionally, stock markets allow investors to diversify their portfolios and spread their investments across different stocks, industries, and sectors, which helps mitigate risk and reduce the impact of any single company's performance on the overall investment. By diversifying, investors can potentially achieve more stable returns and protect their investments from excessive volatility. 5. Employment and wealth distribution. The functioning of stock markets has a direct impact on employment and wealth distribution. When companies receive funding through stock market listings, they can expand their operations, invest in new projects, and hire additional employees. This job creation stimulates economic growth and reduces unemployment rates. Moreover, stock market investments can contribute to wealth accumulation for individuals, allowing them to build financial security and enjoy improved standards of living. However, it is important to note that wealth accumulation through stock markets can also lead to wealth inequality, as not everyone has equal access to investment opportunities. The lasting impacts of stock markets on an economy. When stock markets experience a rise in prices, investors see their portfolios increase in value, creating what is known as the wealth effect. This surge in wealth has a significant impact on consumer behavior and spending patterns. As individuals feel wealthier, they are more inclined to increase their spending on goods and services, which fuel consumption. This increased consumer spending, in turn, stimulates businesses across sectors, leading to revenue growth, expansion, and job creation. Also, the positive cycle of spending and investment contributes to overall economic growth. Moreover, the stock market serves as a vital source of corporate financing. When companies decide to go public through an initial public offering, IPO, they offer shares to the public in exchange for capital. This influx of funds allows companies to invest in research and development, expand their operations, and pursue new market opportunities. Hence, by accessing the capital market, companies can raise substantial amounts of funds quickly, which may not have been possible through traditional debt financing. And the availability of capital through stock markets promotes innovation, job creation, and economic development. Stock markets also attract both domestic and international investors who seek profitable investment opportunities. A well-functioning stock market acts as a magnet for capital as investors seek to benefit from potential returns on their investments. In addition, increased capital flow into the country has several positive effects. Firstly, it provides companies with access to the funds needed for growth, expansion, and innovation. Secondly, it enhances liquidity in the financial system, making it easier for businesses and individuals to access capital for various purposes. It can also strengthen the domestic currency, making imports relatively cheaper and boosting export competitiveness. Some challenges stock markets may face in growing an economy. While stock markets are essential for capital formation, investment opportunities, and economic growth, they may face various challenges that impact their role in a country's economy. These are: 1. Systemic risk. Stock markets are interconnected with other segments of the financial system, making them susceptible to systemic risks. A severe market downturn can have far-reaching consequences, impacting banks, financial institutions, and the broader economy. Hence, managing systemic risks, such as contagion effects and excessive leverage, is crucial for maintaining financial stability. 2. Regulatory and compliance challenges. Regulating stock markets is a complex task, as it requires balancing investor protection, market integrity, and promoting efficiency. Hence, regulators need to continually adapt to evolving market dynamics, emerging technologies, and new financial instruments to ensure robust oversight. However, striking the right balance between regulatory oversight and allowing market innovation is still an ongoing challenge. 3. Market bubbles. Stock markets are prone to experiencing speculative bubbles, where prices of certain stocks or sectors rise rapidly and become detached from their underlying fundamentals. The dot-com bubble in the late 1990s and the housing market bubble that led to the 2008 financial crisis are very notable examples. So the bursting of such bubbles can have severe consequences, including significant market declines and economic downturns. Conclusion. In conclusion, the stock market plays a crucial role in shaping the economy of a country. It serves as a platform for capital formation, investment opportunities, and risk management. The performance of stock markets affects consumer behavior, corporate financing, business confidence, and capital flows. So whether you are a potential investor, a business owner, or simply someone interested in the economy, grasping the workings of the stock market empowers you to understand and navigate the interconnected world of finance.